Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. In the process of heading lower from the break below the late June, late July ascending triangle, that's the one highlighted in dark blue on my daily chart, in this process of heading lower, the market created a late July, late August bearish shift pitchfork, which you can see highlighted in purple on my daily chart. This pitchfork had been brilliant at showing the bearish angle of attack of this market from late August until 2 weeks ago, when the market broke up over the upper time, currently at 1270. The reason I said broke rather than breach was that 2 weeks ago we had a weekly key reversal up, and if you're going to break a pattern such as this bearish shift pitchfork, then there is no better tool than a weekly key reversal up, apart from perhaps a monthly key reversal up. Anyway, last week the market approached its first real test overhead, and that is the declining short medium moving average, currently 1332. This is not that heavy a resistance, though it did a good job of capping the market back in late August. Well, last week it did a pretty good job of capping the rise then, as prices peaked last Friday just under it, before coming back down to sit on the short moving average, currently at 1303. It's worth noting that more forceful resistances lie overhead, notably the recent 50% Fibonacci line at 1349 and a slowly declining long moving average, currently 1404. And this is before mentioning the overhead band of congestion between 1378 to 1409, a band I've spoken about in earlier times, as back then it contained the base of the earlier late 2022 descending triangle at 1378, and also the lesser Fibonacci line of 1409. For the moment, the market hasn't made up its mind whether to head higher or lower, but I would point out that perhaps time is not on its side. As though the short medium moving average is slowly declining, it is still nevertheless declining and may become an additional pressure on the downside soon. Chicago soybean meal. In the process of moving lower since the start of August from the break below the mid-June to early August ascending triangle, which is highlighted in bright red on my daily chart, the market formed another pattern, a late July to late August bearish shift pitchfork, which you can see highlighted in purple on my daily chart. This pitchfork gave a brilliant indication of the bearish angle attack from late August until 2 weeks ago. Now, there was no weekly key reversal up here 2 weeks ago, as we saw in soybeans, but that did not mean it was not immune from effects of what happened in soybeans. No. We saw this when prices punched up through the upper time, currently at 370.60 of the bearish shift pitchfork. The market consolidated at the start of last week, but has since moved higher, overcoming the first three overhead resistances of the declining short medium moving average, currently 396.20, and the combination of the medium moving average, currently 404.60, and the 50% Fibonacci line of the October 2021 to March 2023 move at 403.60. These all became supports at the end of last week and the start of this week, for a strong move higher over this week, up through the lesser Fibonacci line at 415.5, and towards a combination of the lesser Fibonacci line at 425.90 and the more important declining long moving average, currently 426.90. As I said last week, and I quote, we really start hitting some serious resistance up around the lesser Fibonacci line of 425.90, because it would seem that if prices were to get that high, then the addition by then of the declining long moving average would reinforce what would seem pretty light resistance. And that's the end of the quote. Well, that is just about what happened as prices rose to test the declining long moving average yesterday, but failed just to manage, with the high being separated from the long moving average by the width of a sheet of paper. Yesterday also turned around, and the market turned around and headed lower, becoming a bearish harami in the process at what might be the top of this recent rally. We'll have to see on that still. Today prices have headed lower, though the lesser Fibonacci at 415.5 through there, but slowing upon approach to the combination, or just going past that 415.5, but slowing also an approach to the combination of the medium moving average and 50% Fibonacci line below. This, despite its lack of showing on the way up, may be the next real test on the downside. All this action of the last few weeks has set up the opportunity for October to be a possible monthly key reversal. Thus, if we close on Tuesday the 31st of October, either over 404.70 or under 381.20, then we'd be on. Anything in between and would have a lesser outside month pattern. Right now, we are still on for a monthly key reversal up. Finally, this brings me once again to my final point, which I raised 21 weeks ago and which I will keep raising for the rest of this year at the very least. You see, on my longer term monthly charts, with 10 months of the year gone, 2023 is set to possibly be a rare annual key reversal. Thus, if we were to close on New Year's Eve, either above 471 even or under 399.10, then we'd be on. Anything in between will have a lesser outside year. Right now we are looking at an annual outside year, but we still have so many months still to go. Chicago soybean oil. The recent key pattern here had been the late June to mid-August head and shoulders top, which had an extension or handle to it. The primary target for this pattern was in the 60.38 zone, which was achieved in early September, and with a secondary harder to reach target down in the 56.74 zone. 4 weeks ago, the secondary target was achieved, but in the process of heading lower from this head and shoulders top, the market made a descending wedge pattern, which, though not highlighted, you can still see it on my daily chart. This market, much as soybean meal, was not immune to the weekly key reversal up in soybeans themselves, and turned a test lower early 2 weeks ago into a break up over the upper trend line, currently at 51.10, of the descending wedge pattern. However, the move higher here has not been as successful as we have seen elsewhere in the soybean complex. Indeed, prices quickly turned lower and have been trailing along the breached, not really yet broken upper trend line, which leaves a big question mark on this market. Immediate overhead resistance is from the February 2013 high at 54.15, though I have doubts about its integrity given what happened on the way down. And this is followed by the more formidable resistances that start at the 50% Fibonacci line of the March 2020 to April 2022 move at 56.34 and rise up in stratified layers up to 59.44. Within these stratified layers, you will find the slowly declining long moving average, currently at 58.04, the August 2011 high at 58.59, and the recent late May to late July 50% Fibonacci line at 56.91. Meanwhile, below, well, we didn't have that much support until prices started approaching, as they did back earlier in October, the March 2013 high at 51.26. Finally, and this refers to my earlier statement about the larger descending wedge pattern seen earlier this year, I said the following some 17 weeks ago, and have since, on every opportunity, said so, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." End of quote. I will not expand on this idea any further at this time, but it is still early on. But the recent market decline fits in with this idea, though the expectation would be to eventually witness a fall down to the area of the May and June lows between 48 even and 46 even zone, which is possible, but may be a little hard to see right now. However, I do wish you, and also me, to keep this idea in mind, especially following such recent actions as seen here and elsewhere. It might actually fit in well into such a pattern.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.